Hey guys, welcome back to the Capital Mindset Show. Today's a special episode. If you guys are watching this in the morning, unfortunately, well, maybe not unfortunately, you guys can sit back and drink a beer with me as we talk about stocks, and particularly the theme of the occasion is beer stocks. Right here, I'm drinking a stout, a Guinness. So we're going to be talking about two individual beer companies, and we're going to see whether or not they're interesting and maybe attractive additions to the portfolio, or whether they're a little dangerous right now. All right, but that's for you guys to decide. I'll be sure to give my opinion though. I could be wrong, so don't take my opinion as the law by any means or stretch of the imagination. And as always, if you guys have any questions, please feel free to leave them down in the comment section, as well as leave different requests. And we're working right now on a couple other international stocks that we had some requests about, but we had to retrofit the model. And I'm working on that diligently to get the model to work where the data can aggregate correctly under IFRS. But that being said, let's actually get started and look at the first one. So the first company we're going to look at is Sam Adams, right? So Sam Adams is a well-known beer company that has been on the up and up, taking away tons of market share from the legacy players. Now, from this, we want to actually take a look at the performance over the longer term. So you can see this massive run up, right, since its IPO. And it had this actually downtrend, and this is a long time that someone could have been investing in. But regardless, the point is what we're trying to see here is this massive trend upwards over the course of the pandemic and after the pandemic, and then afterwards this massive correction. Now the question now becomes, is this correction good enough for us to jump in? We see this massive correction down and down and down and down, and then we see it continue. So the trend is down. And now the question I'm going to ask is the performance suffering, or is the company better than ever, right? And with that, let's actually take a look at the company. So let's take a look over here. So actually, let me actually add in the ticker. Okay, so right off the bat, doesn't look like a decent value. Okay, but someone might be pointing out something that's wrong, all right? So the average growth rate over the past years has averaged out to 20%, and none of the assumptions I have on the screen are anywhere close to that. So, well, except 17% is pretty close. So let's add 20%. Okay, so now we're starting to see a little bit of the story. It's right now tremendously overvalued for what it is. We're demanding of it. And if we're going to discount it at about 15% or require a 15% rate of return, then we're not going to be able to potentially achieve that based on the fundamentals. Now, let's actually see what we can assume. And that's simply by going through our model and kind of figuring that out. So it appears to me that we have to assume greater than a 40% rate of return. So basically a 41% rate of, 41% growth rate on the cash flows. And then we can safely assume a 15% rate of return over the course of 10 years, of course, compounded. And we're not assuming any buybacks or share dilution at the same time. So one thing I want to address with this company is their balance sheet. So let's actually take a look at their key ratios. And something that we can actually point out is the lack of debt. Okay, so this is very good, very favorable for this business, because I will take a look at another company in just a second. For those of you may be seeing it up there in the tabs, but it's a good position to have, where you can you have a lot of levers to pull in terms of where you can draw capital from and invest in the business to grow into different avenues, maybe create different products that can target different niche markets within the consumer base. Everyone has different tastes. I personally am more of a stout guy. Some people are seltzer guys, you know, for those of you who are. I'll drink to you. Some people like the clearer beers, like Corona and stuff like that. So these different tastes, you want to develop a portfolio of brands that can satisfy each of those tastes. So just looking at the performance on the gross margins have been coming down. That may be because of certain acquisitions they've done or certain inability to scale their supply chains. But it's nothing too terrible, but it's something you want to keep an eye on, because that's 100 basis points right there. That's 10%. So sorry, 1,000 basis points. So we want to make sure that such a thing does not continue. And we want to make sure that management is doing their best to get it back on track. Okay. And so operating margin is also suffering. Net profit margin is subsequently suffering. So decent numbers in the past on return on assets, return on equity. I would have much rather been an investor back then than today. Because not only would I have had tremendous capital appreciation, probably thought about selling as the numbers were decreasing, but that's neither here or there. We don't know that, to be honest. So let's take a look at the earnings quality. Okay, so earnings quality is typically, this is a unique score we use here in Capital Mindset. I developed so that it could keep track or give a scorecard to the accountants at a firm and tell me how management's doing. Okay, so for me, it looks good, except for this year. This year, it's not too good. But I'll count this as a fluke year. I'll give them the benefit of the doubt. Book value per share, kind of care, but don't care really, because you're probably not going to be able to get the company at that price. And then now we want to see this. This is actually very important because this is an inventory heavy business. So if you decided to join me on this little drink, we need to get that beer somehow. So that's us going to the store, getting the different products that we desire. So inventory management is very important, because that can over time hurt a company if they don't manage it correctly. And we want to see these things improving. And we have the column here on the right to help you guys if you guys are watching along. And making sure you guys can follow along and see, okay, well, that's improving, that's improving, that's improving. So without kind of delving too much deep, you can pause here and kind of see for yourself what's improving, what's not improving. But I'll highlight something that's important. So we want to see the days of sales on inventory. Okay, so that is typically what I'll look for here. It's been going down, but just slightly. 2019 was a kind of a bad year, but not really in the grand scheme of things. They haven't gotten back to 2018 levels. And then that's pretty much it. That's kind of sticking out to me. Cash conversion cycle is getting better, drastically better. That's a good thing. And again, if you have any questions, you can leave them down below and I'll get back to you, try to answer them. If you have any questions about this stuff, little details on finance, financial analysis. So going away from that, I want to go back to here and kind of take a look at some of these charts. So what we have here, these are some new features we added. It's pretty simple, straightforward. So this is just a simple trend analysis. So basically, we can ignore this one because this one's just going off of the recent negative cash flows, and then assuming that they're going to continue, but they're probably not. Because of this drastic drop here. It's probably something to do with some changes they've been making in terms of their CapEx. CapEx may have increased dramatically, and we can actually check that to answer some of these questions here. And right here, okay, so cash flow from operations has gone down and CapEx has seemingly gone up, right? Yeah, so CapEx has gone up, slightly. It's gone up quite a bit from over the past couple of years, but cash flows from operations has decreased drastically, and it's because of this line item here, change in other net operating assets. So they probably got rid of some assets, or they've increased their operating assets, but they have a negative cash amount there, and then they have also a large amount in the line item there, which is changes in inventories. Okay, so that's inventory management. Like I was just saying, inventory management is very important. So that's driving negative cash flows right now because their CapEx is now greater than their cash flows from operations. Now going forward, will that change? Well, let's see. So that's something you want to keep an eye on. All right. So I think before we finish off, I think we got to get a little bit more in touch with this company, And we can talk about some of their brands that you may or may not be familiar with. Some people may be huge fans of their beer. I'm a fan. I don't think anything, you know, terrible of the business or the different brands that they own, but they own, here, we'll actually go over them together. The first one being Samuel Adams, right? And then we have Dogfish Head, and then we have Truly Seltzer. I'm not really a seltzer guy. Twisted Tea, some people I've heard really like that one. I think it's okay. I like it. Angry Orchard, another one. It's hard cider. And then these are some of them that they have. Havana Lager, so, or Lager, however you want to pronounce it. So that's to go over some. Not too many brands. You know, it's not like Anheuser-Busch, but you know, no pushover either. It's not your local small brewer. Okay, so now we're moving on to the second beer company, and the second beer company is Molson Coors Brewery. So let's go over some of their brands first. I probably should have gone over the other one's brands first before the numbers. But here we want to take a quick peek at these brands. And we got those right here for you. So I don't know if any of you guys can tell for yourselves whether or not you've tried some of these brands. Blue Moon, definitely tried that one. Coors Seltzer, you know, more seltzer. There you go. Everyone's in seltzer. So I'm not going to cover these. These are too many brands, but you can pause the video and say, oh, I know that brand, or go visit the website yourself and you can see the brand for yourselves. And yeah, oh, so I'm going to highlight, this is why I'm here. I'm going to highlight some of the brands that I want to kind of bring more attention to. So it's ZOA energy drinks. That's the Rocks drink. They also have his tequila in here somewhere. And they also have Topo Chico, the hard seltzer version. So from what I've gathered in the market research, I've seen that the Topo Chico hard seltzer has done fairly well in terms of getting some market share. Right here. There it is, Topo Chico hard seltzer. So Molson Coors Brewery has done some initiatives in terms of trying out these different things in order to tackle the market. For example, I know of a couple people, it's anecdotal evidence, mind you, but you should see in yourselves in your own lives whether or not the products are having a meaningful impact. But ZOA, for example, is having a meaningful impact in my life in terms of the amount of people I see drinking ZOA. But that could be just where I live. That could just be my circle of influence. But that's interesting to note. And I know that The Rock is an influential person who, you know, has put in a lot of work to back this drink, back his other drinks. And then he has an agreement with this company that any drinks he develops in the future will go, they will distribute and produce. So that being said, that's some of the art side. Let's get into the science of investing and let's take a look at the model. So let's actually go ahead and put the ticker symbol in there. Okay, so right off the bat, we see some interesting proposals. So if we assume, for example, a 70% rate of return, copying from the Boston Beer Company, that would be a tremendous amount of return potential because I think we can discount past 20%. And I was correct. We probably discount at 22. Okay, I'm a little off. 23, mental math. Ooh, can we get to 24? No, we could not. We're just about there. So in summary, right here, Molson Coors is trading at a cheaper valuation. It makes sense. It's more of a considered to be a struggling business. So we can kind of see here the sales trend line over here. So we're actually getting a little dip, but we may perhaps see a pickup, and we see a little pickup right here on the tail end. And then so we can see the simple trend analysis from the model is telling us that that's kind of the projections that may go depending on whether or not you trust the statistics. And then the cash flows, it's saying, oh, basically flat. But then again, it's going off of the trend line. So this is different ways of looking at the same thing. So we can look at one or the other. At the end of the day, the model's asking us what we think. And then that's what we're going to put over here. So we want to see, for example, the recovery period, because it seems like it's going through a cyclical downtrend, and that's what the message is telling me over here. So looking at this, the recovery period, I want to say, okay, well, let's say we can recover in like 2 years and then push past that going forward. So I want to say, let's see, we can say let's say 5%, and then let's actually bring that down to 20% discount rate. And let's do 6, 7, 10. Okay, so let's get rid of the 5 because we know that doesn't work. And then 12%. Okay, so if I can assume a 12% growth rate in the cash flows, I can generate about a 20% rate of return. I'm not going to be assuming buybacks or share dilution, but let's see what we're looking at here. So the average buybacks, they've actually diluted us by a little bit over time. So now when I assume my scenarios, I'm not going to assume a buyback. I'm going to assume a share dilution that continues. And then so still still kind of looks good. Let's actually assume a 1% share dilution. So now I can kind of see if I can pick this up at $41 a share, that will be a decent entry point if we want to assume a 12% rate of return, because if that buyback doesn't happen, then I'm in the clear. Again, we are using a pretty high margin of safety. Some people might say the 20% discount rate is pretty hefty, but we're assuming a decent margin of safety to account for the uncertainties that we may otherwise incur. So if we assume a 15% discount rate or 15% required rate of return, we can kind of see how the numbers or the model spits out different prices that we should enter a position at. So looking at the model, I can assume now a 7% required rate of return, and I can still, sorry, not required rate of return, 7% growth rate in the cash flows, and I can still assume a buyback of a negative 1%, which is share dilution, which is actually, that's rather incredible, because if they don't dilute and they do some sort of buyback where they issue a dividend and I reinvest the dividend, then that kind of changed the numbers into my favor. So let's actually take a look at some of the key ratios, and we can take a look at what's going on under the hood. So the solvency ratios seem to be pretty good, actually improving across the board. This is a good thing. This is management actually making the business healthier over time. They probably did some acquisitions in the past, and then they wanted to fix that over time. I know that they stopped the dividend during the pandemic, and then now they're bringing back the dividend. I think it's already reinstated. Gross profit margins went through a trough period. Now they're on the recovery. This is good. Net profit margins are still negative, but that's on a GAAP basis. I have my tendencies to have problems with GAAP numbers at times, but it depends on the company, depends on the nuance of what we're looking at. So it's not all black and white. Looking at the scorecard for the earnings quality is pretty good. Even negative numbers are actually good. So that's not how we read it. So basically anything under 1 is not good, but if it's above 1 in absolute terms, then we like that. Okay, so what I want to look here is the book value per share. So it is trading below book value, which I said, for example, in Sam Adams, I said, I don't really care because you're probably not going to get it at below book value. Now here we're getting hit at below book value. So that is indicator of how cheap this business is. And so between the two businesses, if you're looking for a cheap beer company, this is clearly a cheap beer company. Now, do you want to be involved with this beer company? I don't know. I'm getting interested now. I'm raising an eyebrow. So let's take a look at the inventory ratio. All right, pretty good cash conversion cycle. I'm liking that. Accounts receivable turnover. So I know that, for example, Molson Coors deals a lot with restaurants. Remember, all these businesses actually do. A lot of their sales go to restaurants, and so the restaurant category, as it's coming back, we should see standard improvement across the board in those avenues of business. And okay, so inventory turnover is getting worse though. So days of sale inventory, it's getting worse as well. So some of these things are, it's give or take here and there. But overall, I'm actually really impressed with what the management's been doing, because I know I've been keeping track of this business for quite a long time, about 4 years now, and I've been waiting and waiting and waiting for something to materialize before I would ever hop in. And I have to say, I'm getting interested now. I think now there is a interesting risk reward profile, because again, I'm assuming a dilution of 1% every year for 10 years, and then I'm discounting it at 15%, which is about 50% greater than the market return on average. And I'm getting interesting buy prices. So for example, at 7%, that we're basically there. If, for example, that changes to a 1% buyback, which it says based on the cash flows, they're capable of doing 10% a year at current prices, which is rather amazing. And then if we take into account the dividend and you reinvest the dividend and your ownership grows over time, those returns can compound into your favor. So if we assume the buyback, then the number changes to the opposite in terms of how good it is, because now you can see I can assume a 6%, and dare I say it, let's see if I can assume a 5%. I can assume 5%. And if we assume, let's say 3%, let's aim for the low. Okay, so 3%, I can almost assume a 3% growth rate in cash flows and still come out with a buy price. So in summation, between the two businesses, I think I would be more interested in Molson Coors at current prices. However, as the business goes, Sam Adams is the more exciting one. It's the one that people are talking about more on this platform. But oftentimes it's the one that's overlooked that can be the better investment. I can do another video going forward on two more companies. I can do Constellation Brands and Anheuser-Busch. Let me know down in the comment section if you want me to do those two. Those are other, the reason why I would do those two together is because they have an agreement with one another, but that's neither here or there. And then there's also another player in the hard liquor category, Diageo. And so they're kind of like in a league of their own. And then you also have Louis Vuitton Hennessy, or Hennessy Louis Vuitton. And that one's more of the big conglomerate in all these luxury categories, which is why I wouldn't really put them into the same league. But that's so far, that's what I'm at with Molson Coors and Sam Adams. If you guys like this video, please feel free to leave a comment with a question, and please like the video. Again, if you did enjoy the content. If you didn't enjoy the content, you can leave a dislike, and you can bash us in the comment section, and give us some criticism of where you disagree or agree. Maybe Sam Adams is the better investment and I'm just overlooking something. Right now, neither of them are in my portfolio, so I'm actually not long either of them. The one I would be long, or I'm thinking about being long, is Molson Coors. And this one, let's talk allocation strategy, because a lot of times I get questions in the videos about allocation strategy. So actually, I'll go ahead and cover that now. So basically, if I'm going to add this to my portfolio, I would first address my portfolio in terms of how much is already exposed to similar categories. And then I would allocate that within that category of my portfolio. So it'd be about, I think that category as a whole makes about 20% of my portfolio. Well, actually, no, I just checked, it's 15%. Yeah, I just checked yesterday. And so within that 15%, what addition will this make? Will I sell some other shares that I have to add to this position? And for sizing, Molson Coors, because of near-term risks in terms of solvency or something crazy with the US stock market and gas prices and inflation, I want to actually kind of like a wait and see how they can handle the supply chains. But I don't want to simply stand by and just wait. I'll just nibble here. And then if the price starts to retreat closer to the $40 mark, that's where my bites or nibbles will turn into bites. And then if it gets in the 30s for some reason, those bites will turn into gulps, and then I will start adding large chunks of the portfolio. And it could reach as high as about 5 to 10% of the portfolio as a whole. It depends on the price that it gets at. So with that being said, guys, thank you guys for watching. And if you were drinking a beer alongside me, here you go. Cheers. And hope you guys have a good one. Bye.